Welcome to Supply Chain Insights webinar, Supply Chain Metrics That Matter in a Market-Driven World. I'm your host, Allison Crawford. There are many supply chains out there today. However, not all are functioning at an optimal level. There are inefficiencies in operations, bottlenecks in communication, and functional misalignment preventing organizational growth. There are organizations that have identified a path to success and are following it to outperform their peers in revenue growth, inventory turns, and return on investment. In the second Supply Chains to Admire research, Supply Chain Insights has done the industry analysis to identify the companies across 15 verticals that have created high-performing supply chains and is creating a series of reports to share the results of who is winning and why. In this webcast, we'll share with you the first 4 winners in our Supply Chains to Admire research, along with a look at the methodology we use to rank them. Before I hand this over to Laura to go through the deck, there are a few things I want to cover with you. To start, as some of you have heard, we may have experienced a short drop in audio today. Some of you who follow Laura on LinkedIn and Twitter know that she's in Cairo as a guest of the Egyptian government to participate in the celebrations for the expansion of the Suez Canal. We've tested the audio this morning, and we've experienced a few short drops in service, but we've been able to reconnect the signal pretty quickly. So if we do experience a drop in audio, please bear with us, and we'll get the connection back as soon as we can. We're also recording today's session, and we'll post it to our on-demand webinar page. You can visit our website to listen to this or any of our other webinars. Additionally, we'll send out the slides to all the attendees within 24 hours of the presentation. We encourage you to share these slides with others in your organization, and if you have questions, reach out to Laura or myself to set up a discussion. Also, we want to hear your questions about our findings. Please post to the Q&A or chat function to the left and bottom lower left of your screen. We've left some time at the end of the webinar to address questions. Finally, we're going to be live tweeting this webinar, so if you'd like to join the social media conversation, you can use the hashtag SCIWebinar and the @ SCI Insights LLC during the event. Now let me introduce Laura Cesari, founder of Supply Chain Insights, prolific author and blogger, and supply chain thought leader with deep industry experience in industry as well as research. Now I know we've got quite a few slides to share with you today, so without further ado, let me hand this over to Laura.
Well, thank you so much, Allison, and thanks for folks joining us. I would love to have people join us with chat questions at the bottom. If you have a question as you go along with the detail that I'm going to share with you, just put it in the window and I'll take the questions as we go along. Many of you follow us, and you know we write for the average Joe, for the supply chain leader who's trying to figure out how to drive supply chain excellence. And it's not easy. One of the reasons why we're studying supply chain excellence is because we want to understand what drives effectiveness. And so as companies are working on cross-functional processes or new technologies, they want to know what helps them to do supply chain even better and what are the impacts of doing that. So that's how we started this research. 2012 was the 30th anniversary of supply chain for writing about it as source, make, and deliver together. It was 1982 when the first academic paper was written for source, make, and deliver together, and we called it Supply Chain. And on 2012, I sat at my kitchen table and I wanted to write a celebratory book about how we had improved cost, improved customer service, improved inventory, and I believed it. I had worked as an industry analyst with over 500 companies, and I believed that we had made great strides in balance sheets. But as I printed public statement after public statement after public statement, I found that I had 2 piles on my desk. One was a pile of companies that were stuck. They weren't able to make improvement in a portfolio of metrics. And the second pile were companies that were making progress. But I was looking for a methodology that would help me to look at year-over-year results because I found that supply chain leaders make improvement in 3 to 4 years, not in 1 to 2 years. And that led me to write my second book, Supply Chain Metrics That Matter, which looks at what are the correlations of the metrics and how have we done by industry. Now what we're doing is we're continuing that research to lead to a third book, Leadership That Matters, and we're also publishing annually on the Supply Chains to Admire research. As we go along, I publish the findings in my blog, and I have 2 soft copy books. So if people would like, more information, these are good pieces to read. The research has been over the last 4 years.
Hey folks, this is Allison. This is exactly the kind of drop that we had been experiencing today, so just hold tight. Laura will be right back.
So when we were looking at the definitions for supply chain methodologies, and I was at AMR, we were looking at how do we define supply chain excellence. And at first we wanted to start, when I was at AMR, which now became the Gartner Top 25, with very large companies. And as I worked with companies, they would often say to me, well, Laura, isn't it possible that we could have a methodology for small companies? And what I wanted to do was create a methodology that would allow me to look at companies by industry irrespective of size. The other thing I wanted to do is I wanted to look at something that was objective. The current Gartner Top 25 is 50% opinion, and it's 10 years, and I think it's done a great job of elevating the discussion of supply chain excellence. But I wanted something that would help us sidestep the issues of opinion. So we started working on the Supply Chains to Admire methodology. And before we get started, I just want to be sure we're grounded in the definitions. So when I talk about the Supply Chains to Admire methodology, I'm going to talk about a couple of definitions. And one is the metrics that matter. And the metrics that matter are the metrics that we have determined have a high correlation to market capitalization. And the market capitalization is the number of shares outstanding by the price of the shares. We want supply chain leaders to be able to make an impact on the balance sheet. So most of our study has been done with public companies, not private companies. We've also done some work around market to book, and we've also done some work around other objective functions with Arizona State University, and we'll be sharing these at our Global Summit in September. The market-driven concept is the ability to sense and respond market to market, from the customer's customer to supplier's supplier. Today, most of our supply chains respond in a rote response, and they're not very flexible outside in to be able to sense and respond. The study is based upon NAICS codes, which is a U.S. Census classification of industry groupings. We did a lot of work around how you define industry, and I got to tell you, there's no pure way to do it. You know, if you think about any company, you'll find that they fit in many industries, but we tried to use the NAICS codes and the assignment by the U.S. Census. We also started looking at what are the methodologies we could have that could help us to look year over year, and we came up with a methodology of orbit charts, which allows us to compare year over year improvement between 2 supply chain metrics. Using the orbit charts and the metrics that matter, we decided to build 2 methodologies. One is the Supply Chain Index, which is a methodology to improve to measure improvement in the supply chain. And one of the things we found as we worked on the supply chain index, we found that it's a lot like the show The Biggest Loser. Often the companies that are early in their supply chain evolution will do very well on the index. They're driving improvement, but they're not performing. So in the Supply Chains to Admire methodology, we wanted to build an objective and an independent analysis that would allow us to look at supply chains that are outperforming their peer group by industry and also driving improvement. So to be a supply chain to admire for 2015, you have to be driving improvement measured by the Supply Chain Index, and I'll talk about how we measure that, and also outperforming on a portfolio of metrics based upon the Metrics That Matter analysis. So if we look at the last decade, we've spent about 1.7% of revenue on IT. We've had a lot of processes and we've had a lot of efforts going into the improvement of supply chain. But when we look at the overall impact of the supply chain, we see 5 things in the data. One, every industry is very different, so putting companies in a spreadsheet and shaking them up irrespective of industry is just really fool's play. The second thing is that we have dramatically improved cash-to-cash cycles, but have not improved inventory turns to the same degree. For those of you who are very aware of metrics, you know that cash-to-cash is the combination of receivables and inventory and payables. And what has happened is we have lengthened payables, pushing cost and waste back to the supplier base. So while cash-to-cash looks like we've made a lot of advancement, I question if we've really made advancement. Inventory has been tougher for us to really drive. When we look at revenue per employee, we've driven revenue per employee in almost all industries, but we've not seen the improvement in operating margin that many clients would like. Also, growth is slowing, and in times of slowing growth, supply chain matters more than ever. So when we look at the companies that are stuck, and we think about, the metrics that matter, when I was studying and actually selling technology, we talked to clients about the ability to put in technologies and drive programs that would allow us to take 2 metrics, inventory turns and operating margin, and often customer service, and to be able to drive them to a best scenario. But what we find is that 9 out of 10 companies have not been able to do that. And in fact, what we see is many companies circle and they're not able to drive performance. And one of the reasons is that the supply chain is a complex system with complex processes and increasing complexity. So we built the Supply Chains to Admire methodology on the basis of this model, that we're balancing growth, profitability, cycles, and complexity. Now, many would say, well, Laura, don't you need another ball here for customer service? And I'd love to have one, but I don't have any good industry standard definition of customer service to compare companies. So in our Metrics That Matter work, we look at complexity as the impact on return on invested capital. We look at cycles, inventory turns. We use operating margin for profitability. We get less distortion on using operating margin than cost per case or EBITDA. And we are also looking at growth. So in the Metrics That Matter work, we started with what actually ties to market capitalization and worked it back to this model to be able to look at it as a complex system. So this is the work we did 2 years ago with Arizona State University. We're actually updating it right now to build linear models and nonlinear representation depending upon the industry. And what we wanted to do is we wanted to see which of the metrics had the highest correlation to market cap. You can see return on invested capital has a much higher correlation than return on assets, or RONA, and that our inventory numbers matter to market cap. Also, you can see that cost and operating margin are important. So we started with building orbit charts to be able to look at what were the patterns. So this is Walmart. This is an orbit chart. And as we take an orbit chart, we're actually looking at year-over-year improvement across two metrics. Here it's inventory turns and operating margin. And you can see Walmart, like most retailers, is making improvement primarily only in an inventory turn biased way. Most retailers are struggling to be able to balance both metrics. And in fact, Walmart is a much better pattern than others. And then we have many companies like Dow Chemical, and you also see this with DuPont, and you'll see this in the numbers I'm going to share with you, where companies are at the same place today that they were in 2000, and they've gone on long and circuitous routes moving through these two metrics because we're not able to balance it as a complex system. So we built the supply chain index to really look at the orbit charts, to be able to look at the patterns between two metrics and balances the intersection of return on invested capital and revenue growth and the trajectory. Strength is the intersection of inventory turns and operating margin, and resiliency is the tightness of the pattern. So we stack rank companies based upon how well the orbit charts and the patterns are defining supply chain excellence. A strong supply chain will have a high return on invested capital and balanced growth, and will have high inventory turns and also be successful in navigating operating margin. And it will be a tight pattern. What you'll see is many of the supply chains have a very wild pattern. And so the Supply Chains to Admire methodology that we rolled out in 2014, and again we'll roll it out in 2015 at our annual conference, the Global Summit, on September 9th and 10th, looks at performance of companies and also looks at improvement of companies. And for this analysis, we're using two time periods, 2006 to 2014 and 2009 and 2014. And what we're trying to do is get two cuts. We want to understand the impact of the recession, and we want to understand how companies are doing. Now, for those of you that followed the research last year, you know that this was the final analysis. We found that industrial value networks were doing better than the process value networks. We also did not find a pharmaceutical, medical device, hospital, or retailer to be on this list. And so what we wanted to do was we wanted to start the program to go back into the industries and look at the addition of another year, and in some cases another 2 years, to find out where we're at. So let's begin the results on our 2015 analysis. Let's start with consumer products. Consumer products is a make-to-stock industry, very focused on serving the customer. And when we looked at this, we tried to break companies into peer group. And you can see that the gray areas show where the companies have a performance greater than the average. As an industry, the performance is better this year than it was last. You can also see that Colgate-Palmolive is the top performer, and someone like Procter & Gamble, who many people think is the best supply chain, is underperforming on return on invested capital. You can also see Reckitt Benckiser is a strong performer and not driving supply chain improvement. Unilever, you'll see, is not meeting the operating margin goal, but has driven more improvement than anyone else other than Tupperware in this particular category. Kimberly-Clark is the new bookend, actually losing steam and falling. So let's look at the orbit charts of these leaders. This is Procter & Gamble. Procter & Gamble was making great progress up until the acquisition of Gillette in 2005. The work with the acquisition of Gillette and other acquisitions and the increase in complexity caused Procter & Gamble to lose steam. You see 2012, 2013, and 2014, they're starting to push back with some of the divestitures. But they still are not performing on the balanced portfolio of the metrics that matter, including return on invested capital. Let's take another company. This is Colgate. Colgate is higher performing than Procter & Gamble when you see the comparison. And you can see that Procter & Gamble, while they are pushing back and gaining ground in 2013 and 2014, Colgate is actually losing ground on operating margin and inventory turns, and has started to look at some investment in new technologies and new processes. This is Kimberly-Clark. Let's trace this. Look at the fall of Kimberly-Clark. Kimberly-Clark actually made a lot of movement. They did a lot of business process outsourcing. They moved their offices. They invested in a lot of programs. And they've had a hard time maintaining balance on that portfolio, and they have lost the most ground in this category. Let's look at Unilever. Unilever is actually making dramatic improvement even though they're not performing at the peer group. You can see particularly with the announcement of Pierre Luigi and the ability to have a supply chain leadership at the board level, they pushed up in 2010, 2011 to new heights, but now they've stabilized and they're not at the industry level on operating margin. So they do not make the supply chains to admire, even though they've driven improvement. The supply chains to admire is about the combination of performance and improvement. So what we do is we map the orbit charts and then we compare them against peer groups. So here you can see Unilever versus Procter & Gamble. This is a peer analysis of pattern recognition. Procter & Gamble is performing higher on these two metrics and starting to push back. However, when we compare Colgate and Unilever, you see a similar pattern, but Colgate is a higher performer than Procter & Gamble, and so you see a greater distance. And then when you compare Colgate to Procter & Gamble, you can see that Colgate is a higher performer. Even though Colgate lost some ground, Procter & Gamble gained some ground, you can see the patterns in what's happening. Also, a story that I think is really significant here is the improvement by Church & Dwight and Clorox. Church & Dwight started a program about 5 years ago to dramatically improve supply chain effectiveness, and you don't see many patterns that are linear like Church & Dwight. So they're making a lot of improvement, and you also see a pushback here by Clorox. So let's switch to the beauty category. You can see beauty is also starting to perform better than they did last year. Estee Lauder has greatly improved performance, as well as L'Oreal. And when we look at these patterns, you can see that L'Oreal is higher performing than Estee Lauder. But when we go back to the analysis for supply chains to admire, you can see that both Estee Lauder outperforms in the categories, and so does L'Oreal, and both of them are doing well on the index driving improvement. So even though L'Oreal is higher performing than Estee Lauder, they both meet the criteria. So for the supply chains to admire for 2015, for the consumer products industry, we selected Colgate, Estee Lauder, Clorox, and L'Oreal. And this is, I think, a story of great supply chain leadership. Colgate has been a long leader in the consumer product space. They often don't speak publicly like others. And then, they're not well known, but their results speak for themselves. Estee Lauder did a major change transformation under Greg Polzer and actually made a lot of improvements. L'Oreal, I've done a number of case studies of L'Oreal. One of the few case studies I know that have implemented cost to serve, and it's actually got one of the smallest horizontal gaps between sales and operations. And Clorox has also been doing quite a bit of work driving cross-functional leadership. So that is the consumer product sector. Now we're going to switch to food and beverage. Food and beverage has been a troubled industry in the last 3 years. As consumers abandoned the center aisle of the store, we saw a decline in demand unprecedented in this industry. And so when we look at this industry and the decline in growth, most of the companies that are competing in this industry lost ground. So this is the beverage industry. We'll start with it. Anheuser-Busch and Coca-Cola. And you can see here, this is Anheuser-Busch, the Bud, versus SAB-Miller. Anheuser-Busch is a higher performing supply chain than SAB-Miller, making more progress. And then we've got the carbonated beverage companies, Coca-Cola and PepsiCo, which lost a lot of growth ground. Coca-Cola is higher performing than PepsiCo. We selected Anheuser-Busch for the supply chains to admire, and I'll talk about that a little bit more. Then when we look at the food category itself, the center aisle, we have a number of companies that are making great improvements. Smucker's is making improvement, Hershey, Danone. However, you can see they're not making improvement on a balanced portfolio. In fact, General Mills, despite the decline in the food category, is the only company that's able to balance this portfolio across a very precipitous downturn in the economy for these particular products. Let's look at General Mills. You can see this is not a pattern with great resiliency. If you remember the Church & Dwight pattern versus the General Mills pattern, but it is a much better pattern you'll see versus their competitors. This is General Mills versus Kellogg. And so you can see that while General Mills is outperforming in operating margin, Kellogg's outperforming in inventory turns, Kellogg lacks the resiliency of General Mills. Kellogg's been through 3 failed ERP implementations, has really struggled to build supply chain leadership cross-functionally. General Mills has been through a number of downturns lately in staffing, but has much better resiliency and much better supply chain operating talent and strategy than Kellogg has been able to bear at this point in the industry. This is Hershey and Danone. Hershey is driving tremendous improvements you can see here in inventory turns and operating margin. However, they're not at the performance level. Danone is actually going backwards even though they're driving some improvement and growth. So for the food and beverage industry, we select General Mills and InBev. So yes, I got a question. Moving to the right is more important than moving up the y-axis. This is true. What we see in market capitalization is that it is the ability to move a portfolio of metrics up against the best scenario versus singular metrics. And many times people will move singular metrics, but the real trick is to move the portfolio of metrics. The chemical companies 4 and 5 levels back in the supply chain have distorted demand signals, and they've also had issues being able to recover against the recession. The areas in gray are the areas where the companies are outperforming. Ecolab has actually driven, some improvement on performance against some of these metrics, and I'll show you some of this, even though their supply chain index for the 2006 to 2014 is not that good. Their recent improvement has been much better. But the overall performer in this particular category is Eastman Chemical. And even though you're going to see a lack of resiliency in the chemical industry that is much worse than food and beverage or consumer packaged goods, Eastman Chemical has the highest performance and is also driving middle-level improvement. Often the companies that will make it to the supply chains to admire will be mid-pack in improvement because it's harder for them to drive improvement. And again, the analogy of the fattest guy, on The Biggest Loser, the company that has the most to lose will actually score higher on the supply chain index. So it's often the company in the middle that does the best. So again, let's look at some of the orbit charts. This is Dow Chemical moving it up to 2014. Look at the lack of resiliency. BASF versus Dow. BASF actually falls out of the supply chains to admire because of lack of movement on some of the key performance indicators. Here we have Eastman Chemical. You can see Eastman Chemical, while they lack resiliency,
they've actually made a great improvement to 2014. And here, Ecolab at the top here, making improvement against many companies in the chemical industry that are stuck, like W.R. Grace or Huntsman or International Fragrance and Flavors. So 2015 Supply Chains to Admire edition, Eastman Chemical for the chemical industry. Now let's take the pharmaceutical industry. The pharmaceutical industry is not known for supply chain excellence. Often there's an inverse relationship between high operating margin and supply chain excellence. So when we look at the pharmaceutical companies and the performance versus improvement charts, it looks like this. AstraZeneca is the top performer, but not making improvement. Novo Nordisk is making improvement, but not balanced portfolio. You can see that the merger and acquisition activity in this particular industry gives us a much different complexion about the ability for a company to manage the balanced portfolio. We have more white space, so to speak, in this particular pattern. Notice that this particular industry is making more progress in operating margin than they are in inventory. There's a belief in this industry that cutting inventory would actually be a bad thing. And what we see is that companies that are doing well on the Supply Chains to Admire have a very diligent look at inventory. So let's take a look at some of the work on pharmaceuticals. Here we have Johnson & Johnson versus Novartis. Johnson & Johnson is higher performing than Novartis. Neither of these companies meet the portfolio metrics. Here we have another comparison of Johnson & Johnson versus Pfizer, so you can see what that looks like. And compare Novo Nordisk versus Eli Lilly. Novo Nordisk is actually making progress, moving on improvement, whereas Eli Lilly is going backwards. So for pharmaceuticals, no company makes the list. Now, I have a question. Will we be sharing the slides after this? Yes, we'll place all the slides on SlideShare. And there's actually a report that goes along with each of these industries. I know it can be a bit overwhelming. We spend about 5 weeks going through each of the industries and looking at the patterns and talking to supply chain leaders. So I know it can be overwhelming in a webinar, but we will be recording this webinar, and we'll also be sharing the slides, and each of the industries have their own report. At the end of the month, we'll be talking about the discrete industries of high-tech, consumer electronics, semiconductor, and automotive, as well as retail. And what we find is that companies are moving at very different paces within different industries. The food and beverage companies have struggled and are actually moving backwards. The pharmaceutical companies have not made much progress since last year. The chemical companies also have not made much progress with the exception of Eastman. And the consumer products companies have actually made a lot of improvement. So it'll be interesting to see what we find in the discrete industries. So, you know, a lot of times people say, well, Laura, let's just cut to the chase, and how do I take what you're showing me and really apply it? We find that the companies that are doing the best on the metrics that matter are actually managing a portfolio of metrics, and that they're managing them cross-functionally, and that they're able to align cross-functionally to drive balance and resiliency. So what does this mean? So when I talk to companies that are doing better than others, I find that they're managing a portfolio, and I give you growth, operating margin, inventory turns, return on invested capital, and customer service as the metrics that I think matter on the effective frontier. And I think cross-functionally, if we can align on these metrics across source, make, and deliver, we can get out unstuck. So remember that 9 out of 10 companies are stuck they're not able to drive improvement on both operating margin and inventory turns. And, the average Joe is asked to improve cost and inventory and customer service and drive growth. And so they're stuck, and the reason that they're stuck is that the functions are moving in opposition underneath this complex system. It's sort of like the decathlon athlete at the Olympics. The decathlon athlete never goes onto the field to score number one in each of the events. In fact, what he wants to do is he wants to place in each of the events so that he can have the highest score. And so the way to do this is to have the functions to focus on reliability and align cross-functionally against the metrics that matter. So, when we think about, the companies, and I sit back and I think about my interviews with the companies, what drives top performance? I think these characteristics speak volumes. Continuity of leadership. The companies that are driving this improvement, I can tell you the name of the leader who has been at the helm and has been at the helm for 4 to 5 years and has responsibility for multiple functions of supply chain. It may not be source, make, and deliver, but it really is either source and make or make and deliver, but it's not just logistics or not just transportation. They're also very vested in supply chain talent development. Some of the first discussions I ever had on supply chain talent development were with Colgate and with Unilever, and so they're very focused on talent development. They're working on multi-year supply chain strategies. You'll notice in the orbit charts that these patterns happen over time, and they're ever so slow in this complex system. And they have clear governance to guide the cross-functional decision-making. One of the things that happens after we've implemented large technology projects is we have greater visibility to data, and then the question becomes, how do we make decisions? And it may sound silly to ask the question, but we did a recent webcast where we talked about governance and where to make the pivot for regional global governance and business versus functional governance. And so governance and decision-making and clear governance cross-functionally for global organizations is an important piece of this. Culturally, they're very different. L'Oreal is very regional. Procter & Gamble is much more global. Colgate is much more global, but they've defined how they make decisions. Strengthen horizontal processes, so the integration of new product launch, supplier development, sales and operations planning, corporate social responsibility, revenue management, horizontal processes, the ability to grow what Fran Sullivan says is a T-shaped manager, and then also excellence in supply chain planning, network design, and inventory management. So it's this mix of attributes that I see that are percolating up through this work we're doing on the supply chain metrics that matter and the supply chains to admire. And over the course of the next 2 to 3 years, what I'm going to do is take the supply chains and the metrics that matter and the supply chains to admire work and interview the leaders to understand what's driving these patterns. And that's my journey to write my next book. But for today, I want to congratulate the new winners to the 2015 Supply Chains to Admire. And we'll hear much more about this at our global summit, which will be in September, where we're going to be talking much more about the methodology and hear from some of the winners. So I have a question. The question is, once wage growth inflates the future, how will companies with large capitalization, more workers on the payroll, be impacted from the operating margin perspective? Well, one of the things that's happening in the investment of technologies is we're actually investing to reduce revenue or to improve revenue per employee, robotics, drones for last mile delivery, some of the collaborative economy, social apps. And so what we're seeing is a redefinition of technology to improve productivity and even more. But I think the real secret of operating margin comes down to horizontal processes and the intersection between revenue management, margin management, sales and operations planning, cost to serve, and bi-directional orchestration market to market. Now, I was asked a question, what do universities need to do to meet the challenge to get on the list? Well, I'm not sure, Don, what you mean here, but I'd love to see the universities do more hardcore work around the metrics that matter. You know, I'm currently a student and I'm doing a lot of work in the academic journals, and I'm not finding a lot of work on the relationship between the financial metrics and supply chain performance. And I'd love to see the universities step up and do more work in this area. So we appreciate you joining us today for our webinar. We will be sharing the results of the discrete industry at the end of the month. We will be publishing every week on a countdown to our Global Summit by industry. So if you have industries that you're very interested in, you can see the orbit charts and the performance as we publish them. They're available on our website. They're available on SlideShare. We write for the average Joe. We have open content, so we share our open content freely. If you have a question or you want to do a comparison of your company on the methodology, we'd be glad to help you do that as well. So I have a couple of other questions. You know, people are saying, you know, how could they embrace this with their teams? Well, you know, one of the things that I find is helpful is when we put orbit charts up to have a team actually go back and look at years and look at the supply chain decisions and what threw the supply chain out of balance. You know, most people are not aware of, you know, all the things that happen that can throw the supply chain out of balance. Maybe it's an inventory target that was not set right, or perhaps it was a failed new product launch, or perhaps it was a new leader, or perhaps it was a merger and acquisition. There are lots of things that can throw the supply chain out of balance. And so when the supply chain gets thrown out of balance, you'll see the curves on the orbit chart. So one of the things to do is to take the orbit charts and actually have a discussion with the team cross-functionally and think about what you could do to drive higher balance. Okay, I think those are our questions today. We look forward to hopefully seeing you at the Global Summit and joining us on our next webinar. And again, we will be sharing the slides and we will be sharing the reports. Thanks for joining us today. Allison?
Thanks, Laura. And I'd like to thank everyone that joined us today. We do want to do some follow-ups. As Laura mentioned, we're going to send out the slides and the recording link to everyone that attended the webinar, so keep an eye out for that follow-up material from us. We also encourage you to engage with us on our social media by following us on Twitter, joining our LinkedIn company page where we share a lot of this research, and following us on SlideShare where we also post all of our research and all of our slides. Next, as we mentioned, we're announcing the additional winners, the next set of winners at our Supply Chains to Admire at our Global Insights Conference in Scottsdale in the Phoenician. So now is your chance to lock in seats to see who won, who achieved success, and learn the insights that they used to get there. And finally, if you'd like to learn more, please visit our website at www.supplychaininsightsglobalsummit.com to register and to lock in your discounted room block. And again, please reach out to us if any of you have any follow-up questions about supply chain. We'd like to help you improve the performance of your operations. So thanks, everyone, and we look forward to seeing you on our next webinar.